Well, hey there, it's Terry Sawchuk from Sawchuk Wealth. It's Thursday, so that means it's time for 3 Minute Thursdays. Want to just take a few minutes today and talk about some of the technical things going on in the stock market. So as you can see here, this is a chart of the S&P 500, and really since October 27th or 30th, somewhere in that neighborhood, we've just had this vertical run up in the equity market, the S&P, I should say. And we haven't had even as much as a 5% correction during that time. And it's gone from 4,200 to close to 5,200. So, that's a pretty big move in a relatively short period of time with really no rest. What I see here, though, is that the momentum, this little wavy line chart shows me that momentum is starting to wane. And the same thing down here with relative strength. It's been hovering along the top line. Anything over 70 or around 70 is really high. We got as high as 84, I think, at one point, or maybe even a little higher than that. So the point is that it looks like momentum is slowing down, and that this run in the equity markets might be at least getting a little tired and due for a bit of a pullback. We've got a big options expiry tomorrow. I would expect that we might pin this thing at 5,200. And then, maybe into next week, we could see it potentially start to slow down. The U.S. dollar has been weakening, and that's actually one of the reasons why. It's no coincidence that if you go back and look, it's the same time that the dollar peaked is where the market kind of took off. And a weaker dollar is typically good for, it's tied to cutting interest rates, and it's good for equity markets. It's also good for the commodities complex. It's a big reason why gold has had such a big run up. If you look at gold, it's been on a pretty significant tear since then too. There's been pockets of volatility, but more recently it's gone pretty vertical. And again, that's generally speaking, if you can see it over here, because of the dovish Fed policy. Plus, we keep taking on astronomical amounts of debt, and this is called fiscal dominance, where government spending has really been accountable for a lot of the growth. So it's something that we're keeping an eye on. When I look at the U.S. dollar again, because it's been weakening, it's opened up the door for other things in the commodities complex. Again, gold, we added uranium. We also added oil and energy back into it because of that inverse relationship. And a week ago, Chair Powell came out and talked about 2 to 3 rate cuts this year. Even though inflation is still running relatively high, I think they're starting to see some breaks in the employment. What happens is every time that the revisions come out, it gets revised lower. Unemployment seems to be creeping up, and we've gotten rid of a lot of full-time jobs and replaced them with part-time jobs, which ultimately is not great for the economy. But I think in the short term, it's still all systems go, meaning that I think the equity markets are going to continue to push higher. We may get a blow off top. And if that happens, then we could see the equity markets go a fair amount higher before they just completely run out of gas and then turn the other way. And that would line up with, kind of when the election rolls around in November. So between now and I would say at least, the middle of summer, I think the equity markets still look positive. Doesn't mean we can't have a correction or it couldn't go the other way. It just means that the backdrop tends to be supportive. So I hope that helps. We're watching this very closely. We'll keep you in the loop, and I look forward to talking to you next Thursday on 3 Minute Thursday.